The world is full of empty cities, not because people don't want to live in them, but because money does. Glass towers rise. Elevators hum. Streets look perfect on a postcard. But behind 1,000 locked doors, there is nothing but echo. We call them ghost cities, luxury deserts. Districts where the most valuable resident is a spreadsheet. This isn't urban failure, it's a different success metric. When real estate becomes a global storage system for capital, occupancy becomes optional. Shelter is the feature. Storage is the product. Part 1. The big picture. Real estate as a global store of wealth. Homes used to be shelter first, and investment second. Today, in many markets, they've flipped. They act like balance sheet instruments. Why? Because the world has more wealth seeking safety than safe assets to store it. Government bonds? They carry yield curves, politics, and sometimes risk. Real estate offers something else. Tangible collateral, local legal protection, a physical asset that doesn't disappear in a market crash. When money is cheap and global capital is concentrated, prices rise far faster than incomes. And when prices rise faster than rents, occupancy becomes irrelevant. You don't need a tenant to validate the value. You just need another buyer validating the narrative. Here's the scale. Global real estate is worth hundreds of trillions of dollars, larger than global stocks and bonds combined. That mass of capital needs storage. Cities supply the square meters. Ghost cities aren't accidents. They're global financial plumbing. Part 2. Case study, the U.S. vacancy crisis. America shows both sides of the paradox. On one street, rents are sky high and apartments are scarce. On the next, entire blocks sit dark at night. Across the country, over 15 million housing units are vacant at any time. Some are seasonal. Some are transitional. But a meaningful slice is strategic. Institutional investors, private equity funds, REITs, pronounced REITs, hedge-backed landlords, buy entire communities. They don't always underwrite rent. They underwrite optionality, the ability to flip, refinance, or convert. If prices rise faster than rents, an empty home is not a failure, it's a financial position. And algorithmic pricing accelerates this. If a landlord keeps one unit empty to justify higher rents across the building, the spreadsheet calls that a good month. Meanwhile, renters compete for the limited stock that still functions as housing. You're not bidding against the dark tower. You're bidding against everyone else for the units designed for people, not portfolios. Part 3. Case study, Japan's IKEA and the demographic cliff. Japan's ghost homes have a different origin, time. Millions of houses, roughly 8 to 10 million, sit empty across the country. These aren't speculative towers. They're aging family homes in towns where populations collapsed. Children left for Tokyo and Osaka. Parents grew old. Maintenance stopped. Inheritance became tangled. Renovating often costs more than the house is worth. Investors run the math and walk away. Japan reveals a quiet truth. Not all ghost cities come from speculation. Some come from demographics. Towns where the people disappeared long before the buildings did. Part 4. Case study, Middle Eastern megacities. Across the Gulf, the emptiness is intentional. Entire districts, planned cities, islands, mega projects, rise from the sand with hundreds of billions of dollars in investment behind them. Skyscrapers glow at night with only a few apartments occupied. But from a sovereign wealth fund's perspective, emptiness isn't failure, it's option value. Why build so much so fast? Geopolitical branding, economic diversification, capital storage under stable, dollar-pegged currencies. These projects attract foreign investors seeking a second balance sheet, tax-friendly, politically stable, and globally visible. From a plane window, they look underpopulated. From a sovereign balance sheet, they look perfectly alive. Part 5. The economic logic behind empty cities. Why build places nobody lives in? Because the numbers make sense to people who treat housing as a portfolio, not a place. Global savings glut. There's more capital seeking safety than safe assets offering yield. A new condo in a stable jurisdiction functions like a private bond, with optional upside. Real estate as a capital sink. Luxury property behaves like a storage vault. You accept low rent because the value lies in liquidity, legal safety, and status. Inflation hedge plus jurisdictional diversification. A property abroad is a second legal system for your wealth. Lights off doesn't mean abandoned. It means ready. Reverse liquidity premium. You pay more to guarantee you never need to sell during a crisis. The premium rises independently of local wage reality. Tax optimization. Depreciation, mortgage treatment, and corporate structures make emptiness surprisingly efficient. Capital flight and option value. For families in volatile economies, a condo abroad is plan B. You rarely live in it. You rarely rent it. You keep it safe. Put it all together, and ghost cities stop looking irrational. They look like global portfolio management written in concrete. Part 6. The human cost. Even without emotion, the trade-offs are clear. Residents get priced out. Units priced for global investors outpace local wages. Teachers, nurses, and workers move further away. Hollowed-out economies. Empty towers support jewelry stores, not grocery stores. Infrastructure strain. Cities maintain roads, transit, and utilities for buildings used only a few months a year. High rent despite empty towers. Luxury emptiness doesn't help the bottom or middle of the market. Wrong size, wrong price, wrong purpose. Housing becomes an asset first, a home second. The social role of housing fades behind its financial role. None of this requires outrage, it simply requires understanding the incentives. Part 7. Why nobody fixes it. Systems persist when every stakeholder benefits, even if the public doesn't. Governments rely on land sales, transactions, and construction to boost budgets. Developers rely on pre-sales and rising comps to secure financing. Investors rely on appreciation and safety. Banks rely on mortgage collateral. Local politics avoids any reform that might cause short-term pain. Regulating one district just pushes capital to another. Real estate arbitrage is global now. No one is home, but everyone is invested. Empty cities are not mistakes. They are storage systems for global capital. They exist for the same reason offshore accounts exist, not for shelter, but for safekeeping. Step back, and the pattern becomes clear. The lights are off, but the ledgers glow. And until incentives change, construction will keep chasing capital, not people. Empty cities are not built for residents, they are built for balance sheets. Stay curious, stay sharp.